Hi, this is Kirk with Forex Strategy Secrets, and we're going to be talking about trends. Follow the trend to the end. The thing that we want to kind of put across is that you find a trend and take trades and trade until the trend is over. So we'll go through some of this material. It's some of the most important material that I think we've ever presented. One of the greatest trading skills a trader can develop is to develop the ability to spot a trend that can last for several hours or for several days. This skill may create more financial returns than any other trading skill you may develop. If you're trading that trend, doesn't mean you have to just take one little section and get out because it turned against you. Traders can make many mistakes. The biggest mistake is trading in the wrong direction. Well, once you know the trend, then you know that you can always be trading in that direction. There are three simple yet very important skills a successful trader needs to develop, and they are learning how to determine market direction on any time frame, execute a simple entry strategy that works every time, implement an exit strategy that consistently works. Now, there are two important steps a trader must discipline themselves to do. So these steps are: set aside time to trade on a predetermined schedule. If you can be at the computer the same time every day, then that would be great. If you're jumping around all the time, that will still work. Being able to determine that market direction on any time frame. I've stressed that a lot. The time frame is very important. People trade according to their personalities and the available time that they have. Now, we have a lot of people that can trade several hours a day. Others can only trade just maybe 1 hour a day instead of 5 or 6 hours a day. And so you need to be able to set that time aside and then trade accordingly based on your personality. People with little or amount of time, or they have an aggressive personality, they're going to find that the smaller time frames may be most attractive to them. And traders with more time on their hands and less aggressive personalities prefer most often, not always, most often that they use the larger time frames. A trader needs to determine their trading style before they begin to trade. So right now, do you know whether you're a long-term trader or a short-term trader? Do you know whether you prefer the shorter time frames or the larger time frames? So just think about that and see which area you might fall on. So this process may be one of the first things you need to do in your Forex education is determine which time frames you want to use, and then you can hone in on a process. How does a trader determine their trading style? Okay, we're going to give a couple of little concepts here. There are other ways of doing it, but here's a couple of questions I think if you asked yourself, it might help you direct as to which way you would want to go. Do I get bored waiting for the larger time frames to develop? And you have a lot of time sitting in front of the computer, and so if you're trading a 4-hour chart, there's a lot of time in between the time 4-hour bars are forming. Or do I get uptight with the fast pace of the smaller time frames? You're trading the 30, 15, 5 minutes. There's a lot of things happening, and sometimes that gets people uptight because there's so much happening they can't keep up with it. So figure out which camp you're in. Some of the people that we've talked to over the years and coached, one individual that Jed was coaching, he was just frustrated all the time, and he was always going against the direction of the trend, and he just couldn't figure out what was going on. Jed discovered something that led him to believe that he might want to suggest this individual use a larger time frame. So he switched to the day, the 4-hour, and the 1-hour time frames, and he became very successful because that fit his personality. He couldn't stand the quickness of the market on the smaller time frames. And then we have the many traders that say, I can't trade because I'm working a full-time job. Well, here's the one thing about the full-time job situation. One is you may want to try the larger time frame. Now, this may not be a personality situation. This may be a time frame issue. Use the day 1 hour 4-hour 1 hour, or the 4-hour 1 hour 30 minutes as your larger time frames. But Once you figure the direction of that trend, then you can still use the smaller time frames to take trades and time those entries on those trades. So the hour and a half that you may have each day to trade, you're still looking at those larger time frames, but once you find that direction, then you can trade in that direction and things will set up for you. You can be able to make some pips. So people who are working full-time jobs or busy schedules, maybe using the long and short-term methods, but using the large term to find the trends and the smaller time frames to enter might be work for you. Other people think that a 30-minute is a large time frame. Well, yes, it can be, and you trade the 30-minute, 15-minute, and 5-minute time frames. That can work as well. So it depends on your personality and how much time you have to work. There's no best style of trading. Each style may result in huge profits. We know people that make a lot of money, and the largest time frame is the hour time frame. The hour, 30, and 15 are the time frames they use, make a lot of money. Another person makes thousands of pips on a regular basis each week, 500 to 1,000 pips, but they're using the week, day, 4 hour to do that. So there's the styles and what fits your schedule. And a larger time may result in fewer trades with larger numbers of pips per trade. And that example I gave you about that individual who makes thousands of pips per week on a regular basis takes fewer trades. In a smaller time frame, people result in more trades with smaller numbers of pips per trade, and they both can be very successful. No matter which trading style you choose, you need to be able to determine the market direction. A larger time frame needs to be determined with each style. Okay, we talked about the larger time frames. Think back through. Larger time frame could be the day or the 4 hour, even the 1 hour, or the larger time frame for a short-term trader could be the 1 hour, 30, 15 minute could be your larger time frame. If you get the right direction on that 1 hour or 4 hour time frame, you can use the 15, 5, and 1 minute to enter. But remember, you're determining the direction of that trend, and that's what you need to do there. Long-term trader need to pick a larger time frame, say the day or the 4 hour, and shorter time traders need to pick a time frame of 1 hour or 30 minute. Just suggestions. You pick your larger time frame and then adjust it, and we suggest that once use the larger time frame to pick your direction, and your smaller time frames use 3 time frames, a larger, a middle, and a smaller time frame, and you can enter on the smaller time frame, but you find the direction of that larger time frame. There was an individual that influenced me. I read an article by him. I don't have the article, I don't remember the name, but his statement was he started trading the direction of the trend on the 4 hour chart, and that turned his trading around. He made his stop losses just a little bit larger and his take profits just a little bit larger than he did when he was trading those smaller time frames, and that turned his whole trading around. But the direction of the trend of the 4 hour chart. So I like the 4 hour and 1 hour as my directional time frames personally. Once you have your larger time frame selected, you need to determine the direction of the market. Then time your entries on those smaller time frames, as we talked about. One of the best ways to determine market direction is to use charting software. Now, we use the MetaTrader 4 software. There's other softwares. They will all have some type of software to help you find the direction of the trend. So, right here, for example, there's just a day chart. I've zoomed way out, so each of those vertical lines, in between those vertical lines, represents 1 month. So there's a year or more here. So you see a trend developing there. Now, you see that right here is a trend coming down, and it went back up. And so this appears to be going sideways here. And then it came down again, sideways, down again, then it went way back up. And so this right to here determined that trend line. So that trend line was drawn based on those 2 points. And so where you have lower highs, in this case, or lower lows, that creates a trend. The only thing I don't like about that is that you waste so much time or so many pips waiting for that trend to develop. If you'd drawn it on this area over here, then when it passed there, then you've added a little more time to your trading. So this is the day chart using moving averages to kind of find the trend. I just put 2 on here. I don't use these 2 moving averages, but I'm using this for illustration purposes. This green one is a little closer, shorter, and you can see how that sometimes the momentum of the market popped up above that moving average. But if you were trading in that direction, you'd still be okay. This is a larger moving average. It didn't quite hit it quite as much. It kind of touched it. And so that would be one almost closer related to that trend line that I drew. Okay, now we will look at some charts a little bit here that I want to point out a concept to you. The market never moves straight down. You can draw lines that are straight, but the market doesn't move straight. It moves down, rests, moves down, retracement, moves down gradually, big down, retracement, big down, retracement. So some of these retracements could be, in this day chart, could be hundreds of pips. That means, that's where we go talking about knowing the direction of the trend on multiple time frames. If you're on a 4-hour chart, there you could have been using that and did much of this retracement. It's a retracement on a day chart, but it's a major direction on a 4-hour chart. So one of the best ways to determine market direction is to use the charting software, as we mentioned, and our nth degree proven trading system will give you the market direction on any time frame. There are more than 4 ways to determine the direction of the trend in the nth degree trading system. For example, you can see that this is a day chart. 5 months worth of time went by. There were 3 trends. This is one big trend, another trend, and another trend. Now, it's important to know when the trend is going to be changing. So I've mentioned here, if you know how to read these indicators, there are 3 times that it told you that these trends were coming to an end. Right here, as this went up, the indicators told you that was going to be ending. As this was coming down, the indicators told you that was going to be ending. As this went up, right here it's turned, and this tells you the market is going to be going down. So those are some trends that take place. Now, they're impulsive and corrective moves. Impulsive, and this was corrective, but then it started telling you that it was going to change. So then this becomes the impulsive and some smaller corrective moves. So what you want to do is be able to turn the direction of that trend quickly. And in our software, you notice there are color changes. Not every color change is a trend direction change. And so you may not want to be trading some of these retracements right up in here. But how do you know this takes place? And that's where knowing the trend direction change, so then you can determine, okay, if I trade this direction, I'll be okay. Now this is a 4-hour chart. It's not the same spot. I wanted to get the one that had the better illustration, but this is a 3.5 week period of time, and there are 4 trends. And so there's 1, 2, 3, 4. How do I know this is a trend? Because these indicators together told me that this was coming to an end. We had an impulsive move, a corrective move, an impulsive move, trend change. Now this is an impulsive move. So here's the concept. Find the trend. You can do a couple of things. You can start trading down in this area on a smaller time frame, so you found a good entry spot, and you could trade up to where it started coming back and take your pips out of that section. Or you can just stay in. This might have been a 50 pip drawdown, and then stay in and go up. This didn't draw down so far, but it said the market was starting to slow, and then you could have traded this whole distance here, knowing these pullbacks are going to take place. You can take 1, 2, 3 trends, or one trend with trading through those rests. So those are the things you have to be aware of. Larger time frame. So this larger time frame, even coming down here, it would be down, rest, down, rest, down. So that's where you make your big money, is trading in the direction of the trend. You notice that every time it does a correction or a consolidation, it doesn't go very far and it gets choppy many times. The bigger moves are when it's in an impulsive move in the direction of a trend. So the larger time frames may give you a trend you can follow for 1 to 3 weeks. The smaller time frames may give you a trend that you can follow for a few minutes up to a few hours. Now this is where I prefer to trade, is those trends that are 1 to a few minutes to a few hours, maybe a day. I hold trades overnight sometimes because it's moving nicely, and that's what you need to be able to determine. That's why we talked about the personality. Then you can find the trend as to how long you'd want to stay in it. Now, many people, when I first started saying is, well, you have to have higher highs and higher lows for a trend, or lower highs and lower lows for a trend going down. And they'd say, so once you determine that, the trend most cases was halfway finished. And so you could trade the last half of each of the trends. Well, the way we determine trends is different than the way that the industry determines trends. We're timing those trades early on. We're getting into them when they're making that change, going short or long, and not having to wait for the higher highs and higher lows to form and draw a trend line. Even those larger moving averages I was talking about and showing you, they've missed part of the trend. If you use smaller moving averages, you get in a little bit sooner. In either case, you may be in and out of the market several times during that trend. We talked about those impulsive moves, rest, impulsive moves, rest, and then you can either take the trade and ride through it. You need to know when the trend is developing and in which direction. So it's just as important to know when the trend is coming to an end. So now, if you have any questions about what we've talked about here, we talked about theory. We didn't talk about all the different ways of doing it and trading. That's a whole course worth of material. And so this is just to kind of give you the concept that this is the thing you need to do first. Find the direction of the trend, be able to find that, and I would suggest finding what trading style. So that would help you determine which time frame to look at. And so you can either email us, Jed or myself, at jed@forex-trading-secrets, or give us a call. Or if you don't have our course material and would like it, I'll just show you the link. You can check it out if you want. Then you can type this link in and see what it costs and purchase the material.